Good evening and welcome to another edition of Capital Market Live on Channels Television. I am Will Ibong. Before we take a look at how investments in Nigeria fared this week, let's take a look outside our shores and see the performance of other global equities. We begin with Europe, where stocks traded lower on Friday as trade and economy remained in focus. The Pan-European Stock 600 ended the day down 0.04%. Now, with sectors in mixed territory, we saw U.S. President Donald Trump, who made a state visit to the UK this week, held a much anticipated call with Chinese leader Xi Jinping on Friday, and it comes after US and Chinese negotiators reached a framework deal on TikTok's US business at talks in Madrid, Spain this week. Now, regional shares that the DAX, the FTSE and the CAC 40 all ended Friday's session lower. Let's take a look at at Asia markets and see how they performed this week. Japan's benchmark Nikkei 225, we see that index paired gains to fall 0.57% on Friday, after the Bank of Japan kept its policy rate steady at 0.5% in line with forecasts. Now, the decision by the BOJ to hold rates comes as Japan's core inflation rate in August fell to its lowest since November 2024 at 2.7%, marking a third straight month of decline. Hong Kong's Hang Seng Index, we saw that close flat at 26,545 points, while mainland Shanghai was down 0.3%. Not a good performance for Asia markets, especially three indexes we track. Now let's look at major indexes in the U.S. On Friday, we saw them notching weekly gains as the Federal Reserve's decision to cut interest rates set in investors' minds. Now, the Dow Jones Industrial Average added 0.37% to close at 46,315 points, now reaching a fresh record high. And the S&P 500 settled up 0.49% at 6,664 points, while the NASDAQ Composite is with that advancing 0.72% to finish at 22,631 points. Now, U.S. equities, I must say, closed out a winning week. Now, let's look at what happened this week. U.S. Federal Reserve Chair Jerome Powell has reaffirmed the central bank's cautious stand despite the first cuts in this year following its latest rate decision. He stresses the Fed remains focused on sustaining price stability and supporting economic growth. Let's take a listen.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level.
That was the U.S. Fed Chair Jerome Powell giving a breakdown of the facts behind the figure, the data, the inflation data, and also the reason for the rate cuts they had this week. Now, the NASD, let's look at our markets now and see how that trickled down. We saw the NASD, that's the over-the-counter securities exchange closing lower, dropping 1% and ended the week at 3,534 points. Market cap stood at about 2.11 trillion naira. Now, trading activity, we saw that gain momentum. However, value jumped 176.55% to 8.5 million units, while value surged. We saw that up 448% to 123.82 million. Now, deal count, we also see that rising about 41% to 122 deals, transactions recorded for the week. Now, on the gainer side, let's look at that very quickly. We see industrial, that's IGI, closing up 18.52% at 64 kobo, and that's leading the gains there. We see Joe Fluids following with a 9.88%, very far away to close at 4.45 naira kobo, and we also see in Presit Baccalaureate PLC closing 9.35% up at 1.52 kobo. Meanwhile, the laggards were led by MRS Oil Nigeria. We all remember MRS is listed on the NASD market now, delisted from the NGX, down 1% to close at 148 naira or 1 kobo. The Affluent Properties down 1.34%. We know the saga that happened this week, the fire there. Hope that's not damping investor sentiment, to close at 20 naira 62 kobo. And the NASD, that's the NASD itself, the exchange, we see that closing 1.36% down at 29 naira. Now, top traded stocks we see this week included Double One PLC, Purple Real Estate Income, and Joe Fluids, and that's all showing strong investor interest in these stocks. Now, let's look at the NGX now, the big guy, the Nigeria's equities market. We see that ending on a positive note with the all-share index rising 0.92% to 141,845 points. Equity cap closing up 89.74 trillion naira. Now, despite the lift in the index, so trading activity eased. Volume dropped to 2.74 billion units. Value also down 85.2 billion naira, and we saw deals lower at 127,284. But looking at the sectors, consumer goods, we saw that leading the gainers with a strong 5.48% gain there. And also we see industrial goods following oil and gas also in the green there, increasing 2.79%. The laggards, we see banking down 2.57%. We also see insurance also down, falling 4.67%. Now, some stocks stood out. Among the gainers, we see Guinness Nigeria PLC surging 28.6% to close at 183 naira 90 kobo. We see Multiverse Mining and Exploration also up 21% to close at 13 naira 95 kobo. And we see Unicell Interlinked, that stock rose 20.28% to close at 13 naira 55 kobo. Now, on the downside, we also have those losers in the market. Omatech Ventures dropped 18.18%. We see it closing 1 naira 8 kobo down. Cornerstone Insurance lost 15.42%, and that dragged its share price at 6 naira 20 kobo, close for the week. And Secure Electronic Technology, we see that falling 12.75% to close at 75 kobo. Now, we look at the top traded stocks by volume. We saw Abe Mortgage Bank, Fidelity Bank, UBA drawing major investment interest from investors, but we do know UBA rebounded, especially after that lackluster result. Investors were not too impressed with that. But to give us more insights and to give us a deeper dive as to why the market performed the way it did, or what are the factors to consider here, we have Professor Uche Waleke. Is the director at Institute of Capital Market Studies, Nasarawa State University, KEFI, and he is also the president, Capital Market Academics of Nigeria. Good evening, Prof. It's always good to have you on the show.
Yeah, good evening, Wills. My pleasure.
Prof, looking at what we saw now, the numbers we have, we see consumer goods firms have delivered strong half-year earnings and outperforming share returns. Right now, the consumer goods index is about 52% year to date. Given that, what makes this sector resilient, especially looking at the results from the banking sector, UBA and Zenith?
Yeah, thank you very much. As you rightly said, the market was actually led by stocks in the consumer goods category. We saw the likes of Guinness in particular, Nigerian Breweries, Cadbury, Unilever. They all, did relatively well compared to other sectors. Sectors like banking. Of course, banking dropped by over 2%, during the week. Now, of course, you can't remove the market from what happens in the aggregate economy. Yes, we know that, relatively speaking, the macro environment is beginning to be stable, and particularly in terms of what we saw recently, the decline in inflation rate, for example, the improved liquidity we are beginning to see in the forex market, the fact that a number of companies now are having more access to forex, unlike before. So these, in my mind, may have contributed to what we see playing out in the consumer goods, segment. The banking sector, of course, is a different ballgame. The banks are still grappling with the issue of, recapitalization. There is also a number of them struggling to also exit the central bank's, forbearance scheme. And you also, as you are aware, a few of them released their first half-year results. And of course, it was a mixed bag. We have one or two of them that I tracked that didn't really do well compared to the results they posted in the first half year of 2024. So that may have also dampened investment, in investors' sentiment, such that today, as we speak, the banking index is slightly below the average. The average of that's talking about the all-share index. Year-to-date return for the all-share index is about 37%. For the banking index, it's slightly below what we have, for the average on account of this, factors that I've mentioned. But of course, amidst all this, there are still those that are, standing out. A number of them too are proven quite resilient. I noted in particular a particular bank that despite writing off huge, bad debts per se of over 700 billion, was still able to post, profit before tax of over 600 billion, and also declaring an interim dividend, just recently. So a number of them are actually showing, resilience, and in my view, it is these ones that investors should actually watch out for. I think, going by their current market price, I think these banks that I've mentioned now, this particular one, the one in particular is underpriced, is undervalued.
Okay, not to say things to consider or things to watch out for here. Possibly, maybe we'll see a pickup in trading for these indexes you mentioned, the banking sector. We see NGX. Maybe this will bring a turnaround. Is considering extending trading hours from, we know starting 9:30, closing currently at 2:30 local time. Now they plan to extend from 9 to 5 p.m. Can you briefly, Prof, tell us how this will benefit the market?
Well, the fact remains that our a number of markets have longer trading hours than Nigeria. If you take the New York Stock Exchange, for example, trading in the New York Stock Exchange starts from 9:30 and ends by 4. So that's 6.5 hours, trading period. If you look at even South Africa, is from 9 to 5. That's solid 8 hours, trading hours. And of course, the one of the longest is that of the London Stock Exchange, where you have trading starting at 8 a.m. and closing by 4:30. So that's about 8.5 hours. So a number of markets, as I said, have these longer trading hours. And what studies have shown actually is that longer sessions, if you like, boost liquidity, market liquidity. So we see in those markets, for example, we see higher trading volumes and values. Okay. Look at what we did last week in terms of trading, volume and value. Trading value last week was just about 85 billion naira. Okay. If you put that in dollar terms, of course, it pales insignificant, compared to what we what we read.
Okay, Prof. Not just to cut. Not to cut your thoughts there, but not just to cut your thoughts there, but basically you've mentioned that because we don't have longer trading hours, that's why we don't have volume and possibly the value we're looking for in the market. But let's consider the cost here, operational challenges here, the cost of will brokers, the market makers, and even investors. What cost would they face if the NGX really stretches these trading hours, and is the market ready for this change?
Yeah, that's the million naira question there. Yes, of course, you just mentioned the downsides. I was talking about the upsides. Okay, liquidity is one of them. All right, the other one too is price discovery. When you have longer sessions, it also allows the market time to digest market information. So to that extent, you can also say it also helps to boost the price recovery. And of course, in terms of revenues for the exchange, revenues for regulators, even revenues for brokers, that's likely to increase. Of course, for each share that is sold in the market, the exchange gets something, and for each share that is bought, the exchange gets something. So the more the activity will have in the market, the more revenues they make. The costs you mentioned, operational costs, yes, that's on the downside. That is given because when you do that kind of thing, you're stretching the number of hours. Of course, you're employing staff. Your overheads will rise, whether with respect to brokers or exchange or the regulator. So that's a fact. That you have mentioned the issue of costs, and that's also why it's important before they embark on this. They should do a study on market readiness. How ready is the market? What's the state of broker infrastructure, for example? The willingness of even the investors. All this should be taken into cognizance before embarking on prolonging the trading session. I would suggest here that instead of going outright from the current 9:30 to 2:30, they may just phase it and start with say 9:30 to 4 p.m. just as we have in the New York Stock Exchange. So that we don't encourage if you like market participants fatigue, which can set in when you have very prolonged a period. So it should be phased. That's my point.
And definitely this is something we should consider, Prof. But we'll take a moment when we come back. Capital Market continues. Welcome back. If you're just joining us, you're watching Capital Market live on Channels Television. I am Will Ibong, and we have in our Abuja studio Professor Uche Waleke, is the director at the Institute of Capital Market Studies, Nasarawa State University, is still in our Abuja studio and is live with us discussing, we're talking about the extension of trading hours at the NGX. Is the market ready for it? What are the cost implications? The other implications we're going to be looking at, inflation, for example, and also you see that moderating in Nigeria, but the US has cut interest rate for the first time. How is that impacting our markets? Professor, it's good to still have you join us. Prof, we've seen inflation, starting to moderate now, about 20% in Nigeria. Hope to see that reality on ground, people beginning to feel that. But foreign exchange, we see that pressures kind of remains, even though we see that stability in the market, because we see that intervention from the CBN to keep that market stable. Which macroeconomic indicators are most likely to influence equities as we see it right now in the weeks or the months or weeks ahead?
Yes, the factors you've mentioned, going to influence investors' decision, in the coming weeks, no doubt. Inflation, of course, is one of them, and the reaction of the Central Bank of Nigeria, to the disinflation that we're beginning to see. Of course, we know that any moment next week, the Central Bank's Monetary Policy Committee will be meeting, and the expectation out there is that the MPC, should begin to consider cutting rates against the backdrop of the disinflation. So that's the expectation, and it's also going to influence equities performance in the sense, of course, once rates are cut, traders, portfolio managers, begin to rebalance their portfolio in favor of equities. Because the reverse is what you have when the interest rates are raised. So there is the expectation that the MPC would cut rate. But I think I don't see that happening this month. Even if it's going to happen, I want to bet that is something that will kick in next year, maybe first quarter of next year. The MPC may still decide to hold the rates even up till November. And that's because, number one, inflation rate remains elevated at 20.12%, for August. And this is against the central bank's target of 6 to 9%. Upper band is 9%. And the target we even have for this year in the budget is, is 15%. And there's also something interesting about the MBS report. If you look at that report, yes, it says year-on-year inflation dropped. It also says the food inflation also dropped. Remember, food inflation is seasonal, caused by seasonal factors, the harvest cycle. Core inflation, if you look at that figure, core inflation on a month-on-month basis actually rose, from under 1% to about 1.4%. So the central bank MPC will also be taking into cognizance that fact, the fact that the core inflation, which I mentioned earlier, is what central banks actually watch. The food component is seasonal, so that may not really be a major consideration. It is a core inflation that is usually more considered by central banks all over the world, and month-to-month core inflation is still, is on the rise. So the central bank will take that into consideration. They will also take into consideration the fact that the FAC has always, has been, the FAC allocations have continued to be on the increase. Just this month, they shared, for last month, they shared 2.2 trillion. So that injection of liquidity into the system, of course, will be watched by, represents, in my view, a downside risk to inflation. And again, bear in mind that the festive season is also approaching. And festive seasons are characterized by, high demand for goods and services. So these factors, the central bank will be watching. Now, yes, it would appear that the world is in a season of rate cuts. We saw that in the US, the Fed cutting rates. The Bank of England, is also doing so. The Bank of Ghana, the other day too, also cut rates. The same with Indonesia, and you can also go on and on. But if you look at these countries, okay, take Ghana for example. Inflation rate now has dropped to as low as 11%. The Bank of Ghana target is between 8 and 10, and it's just close to the target. So that's the 300 basis point reduction by the Bank of Ghana, is largely justified.
Okay.
So that may also be a consideration for the MPC, for the central bank's MPC. But my advice here is that, yes, the rates are high. 27.5% remains very high for the as an MPR. My advice to the central bank is to also consider the corridor.
Okay.
Tweaking the MPR corridor from the current -1 to +5, which I think is very, very wide, okay, to about maybe -2, +3. Because when you do that, you discourage the banks from relying so much on the central bank's standing deposit window. And of course, you encourage them to, trade more amongst themselves, which
Prof,
helps the money market, as opposed to what we have now.
Yeah, Prof, let's just take a look outside what's happening in the U.S. and how that, impacts Nigeria. We're seeing the U.S. Cutting rates for the first time this year, especially with our foreign borrowing. And how does that impact? Shouldn't that be a factor for the CBN to consider possibly to cut rates now that borrowing costs might be tapering down?
Yes. Again, you've made the point. When rates are cut in the U.S., it also means that the cost of borrowing foreign loans, servicing foreign loans are likely to, come down. But in terms of capital flows, it also helps, it's positive for Nigeria, because when rates are cut in the U.S., okay, what happens is that it triggers capital flows into developing economies, including Nigeria. The reverse is what you have when rates are up. If rates are up in the U.S., it triggers capital outflows, from developing countries, because on a risk-adjusted basis, you now find that investing in the U.S. is, preferred. But when they are cutting rates, okay, it encourages capital flows into the country. So we expect to see more inflows into the country. That will help reserves. That will also put the central banks in a stronger position to further defend the naira. So going forward, I expect to see all this rubbing up positively on the forex market, helping us have a stronger naira, okay, which of course will also help to further moderate inflation. So when we have that on a sustainable basis, the central bank can now sit back and then, conveniently, slash rates without having adverse, impact on the economy. For me, I'm for rate cuts. I've always been a dove in terms of, monetary policy, but again, the realities, must be taken into account.
Definitely, we have to consider the realities, stoking inflationary pressures. How can we bring it down? CBN, a lot to consider when they meet next week. Thank you so much, Professor Uche Walike, Director at Institute of Capital Market Studies, and also the President, Capital Market Academics of Nigeria. Thank you so much for joining us. Always a pleasure.
Thank you very much, Will, for inviting me.
And that wraps up another edition of Capital Markets. Remember, whether the markets are bullish or bearish, knowledge is always your best investment. Keep watching, keep learning, and keep growing your financial savvy. You can catch this again on our YouTube channel. I am Will Ibong. Thanks for watching, and I'll see you next week.